right, hello, this is Brian Lysing with Financial Brokerage, and this is the Big Three Advantages of IUL for Retirement Income webinar. I want to thank everybody for joining us here today. The webinar will not go beyond 30 minutes unless you have a lot of questions. Speaking of questions, all of your lines are muted. We do that to cut down on background noise, but you do still have the ability to ask questions and make comments. You can do that near the bottom of the control panel on your screen there. And I will get to as many of those as we possibly can at the conclusion of today's webinar. So I do want to thank everybody for joining us here again. If you're not already familiar with Financial Brokerage, we are a national marketing company working with advisors and agents all across the country in the areas of life insurance, annuities, long-term care, Medicare supplements, critical illness, and disability income insurance. So we all specialize in a little bit different area. I am one of our life insurance specialists over here at Financial Brokerage, and I've been here just over 2 decades at this point in time, after spending some time out in the field selling all this stuff, just like many of you are currently. So today we're going to talk about one product in particular, and that's Index Universal Life, and particularly the IULs that are used or meant for retirement planning purposes. The death benefit is obviously a part of that, but some of these products are designed more for accumulation and distribution of tax-free money. Now, there are a lot of elements a person can go into within an IUL, a lot of things we can talk about, a lot of sales concepts. In fact, I've done several different webinars on this topic in the past, and I've got a few coming up in the coming weeks too. But since there are so many things a person can delve into, I think it's important to have something that you can lead into with a client. If they ask you, why should I put money into an IUL? I'm already putting money into something else. What makes an IUL different? And if you go into too great of a detail, you're going to lose them, right? People don't remember everything you say. So if we can distill those reasons down into probably the 3 biggest reasons a person should use an IUL, I think that's going to make a lot more sense, and people are going to be much more receptive. You can remember 3 items pretty easily. So what are those 3 items? Well, there are 3 advantages that, in my view, are really the biggest advantages to using an IUL for retirement income purposes. And we're going to go a little more in depth into every one of these. But the first item will be the fact that you don't pay taxes on any of the growth coming out of one of these contracts. It makes a big difference down the road. Also, since it's an index product, we don't have to deal with market losses like you would if you had your money actually in some sort of a stock market-based product. And third, IULs typically have very, very low fees when compared to alternatives that a client might put their money into. So those are the big 3 right there. We're going to talk about the first item in the menu there, the fact that we don't have to pay taxes on this money when we pull it out. Now, if that's assuming that we've designed the product correctly to take advantage of this feature. So, there are actually several places a client could put money for retirement, and every one of these are taxed a little bit differently. And there are only a few vehicles out there that give clients access to money tax-free, and some of those actually have some restrictions attached, which makes life insurance look really good in comparison. So, what are those other vehicles? Well, you could put money into something that is taxed every single year. These are typically products you might find at your local bank, and they don't pay very much interest at all. So, these are typically used for just regular spending money or short term. A lot of people put their money into tax-deferred vehicles. We're thinking primarily of 401ks or maybe IRAs. They get a deduction on the front end, and then they pay their taxes on the back end, but they don't have to pay taxes as the money is growing. So that's an advantage, and a lot of people traditionally put their money there. But we're going to discover in a few moments why it may be important to have access to tax-free money in your retirement years. Now, as we look at the other tax-free options out there, Roth IRAs, Roth 401ks, you can only put so much money into those per year. There are restrictions, and certainly with the Roth IRA, depending on the client's income, they might be prohibited from putting money into a Roth IRA. HSAs, you can pull money out tax-free, but that's meant for medical expenses. Municipal bonds, we know those are tax-free to some degree, but what many people don't know is that you do have to put down interest or money received from municipal bonds on your tax return, because if you are receiving Social Security income, the municipal bond income is added into that to determine if your Social Security income is taxable or not. So there's sort of a backdoor tax attached to municipal bonds. Now, what you don't have to pay taxes on is cash value life insurance. You don't have any income restrictions on that at all. The only restriction is that you have to be insurable to get the policy to begin with, and that's why we're looking at cash value life insurance here. Now, I'm going to go over a few what-if scenarios since we're talking specifically about taxes, and I really want to compare, what difference does it make if we have an account where we're taking a deduction today and paying taxes later versus an account where we're paying taxes today but not paying taxes later? Does it really matter, and in what scenarios does it make a difference? So in our first what-if scenario here, we're going to assume that tax rates remain constant, right? Income taxes, today and then in the future when our clients receiving retirement income, they're exactly the same. So what would happen in this case? We have, I think it was a 40-year-old, maybe a 44-year-old that I looked at that has $10,000 to put away into retirement every year. This person's going to do it for 20 years. And in this first scenario, this is tax deductible. So he's getting a deduction. It's going into his 401k, let's say, and he doesn't have to pay taxes as that money grows. When he becomes 65 and it's time to retire, he determines he needs $25,000 of income from this particular account in retirement. Now, since he got the deduction up front, he has to pay taxes on the back end. To net $25,000, he's going to have to withdraw $33,000 plus per year. And at that rate, his income is going to last 18 years. Okay, so what happens if we look at maybe a life insurance situation? Well, in this case, our person is going to pay taxes up front on the $10,000. So that's going to leave us, at least in this scenario, $7,500 to put into the tax-free account. And we're going to assume it's a cash value life insurance contract. Well, since we already paid the taxes, we don't have to worry about that down the road, but we didn't have quite as much money going in either to grow over time. So when we pull out 25 grand a year, that's exactly what we net, and our income lasts 18 years. Now that should look familiar because on the previous slide, which I'll go back to here, our income lasted exactly 18 years. So if tax rates remain constant and don't change between now and in the future, it doesn't really matter, right, if we're getting a deduction today or not paying taxes later on. So why are we even looking at this? Well, here are some possible clues about the future of tax rates. Right now, income taxes are where they are, and they are, you can see according to this chart, at historical lows. And I know this chart stops about 7-8 years ago, so I don't think it reflects the most recent tax law just yet. But the point here is that in the past, the highest marginal rate, and I think probably even the lowest marginal rate, have been much, much higher than what they are today. There are some 90% numbers in there. In fact, even in my lifetime, which dates back to the early 70s, the highest marginal rate was 70%. And we know if we're following the news today, there's a lot of talk about the debt ceiling and deficits, and the government continues to spend money, and it seems like they continue to cut taxes. At some point in time, though, things are going to have to go the other way. There are several proposals out there talking about tax increases for various folks and different types of taxes. So it seems like in the future, if you had to guess, would income taxes be higher or lower than they are today? I think we would all guess and say they're going to be higher, right? Now, this is just a guess. We don't know. But, hey, if we're planning for our clients and doing a proper job, we have to plan for this eventuality. So what would happen to our same client if we saw an increase? Now, we're going to look at different tax rates here, but this is our 45-year-old again, and we're assuming right now he's paying 20% income tax on his money. And so if he decides to put that $10,000 a year into his 401k, well, he gets a deduction today. That's great. He doesn't have to worry about paying the 20% tax. And it's going to grow tax deferred, doesn't have to worry about it until he starts taking out income in retirement. But in this scenario, taxes are higher when he hits his retirement years to pay for all this debt. So now to net $25,000 of income in retirement, he has to withdraw $35,000 a year, and his income is going to last 16 years, at least out of this account. Now, what if we did the reverse? And this person instead put the $10,000, paid the taxes on it, so he's going to net $8,000 today, and put that into a cash value life insurance policy. Well, in the future, once again, he can net $25,000 by taking out $25,000 because he doesn't have to pay taxes on it. But since the tax rate is higher in the future, right, he's got a bigger advantage at that point in time. Now his income lasts 21 years. So now we've gained 5 years of income if we follow the scenario through where the tax rates increase over time, right? It's much better to pay your taxes at the lower rate than it would be at the higher rate. So it makes a lot of sense to have at least part of your retirement income into some sort of account where you don't have to worry about paying taxes in the future. Now, there's a little addendum to this whole tax argument here, and it's the Secure Act. So you may or may not recall, this was passed by Congress in 2019, went into effect January 1st of 2020, right before the pandemic hit, so we all kind of forgot about it. But hey, it's still out there. So the Secure Act did a lot of things. One of the things it did was change the way that qualified funds that pass after someone has passed away, and the way they pass to the beneficiaries. It used to be, if you inherited an IRA or a 401k, if you didn't want to take that money, you could choose to have that distributed over your lifetime through a stretch IRA, and it lessened the tax impact that you had to face. Well, with the Secure Act, it changed all that. Now, beneficiaries of qualified funds must take distributions by the end of the 10th year after the death of the deceased. They don't have to take it all at the 10th year. They could take it up front. They could spread it out over 10 years, whatever they want, but it has to be distributed by that 10th year. They can't stretch it through their lifetime over several decades any longer. So what's going to happen? When do people typically inherit qualified funds? They are probably nearing the end of their career, and when people are at that stage, they are usually in their peak income earning years, probably in the highest tax bracket they've ever been in because of that. And now they're going to be forced to take additional taxable money and pay the taxes on it. Might bump them up into an even higher tax bracket, but even without that, they're already in the highest tax bracket they've ever been in. Not a great position to put yourself into, right, if you could avoid it. But that's what the Secure Act does. And I apologize here. I should have been moving the slides along so you can see what all this means here. And we still have the same argument. Will rates be higher or lower in the future? I think for many people it's going to end up being higher for all of those reasons. So that's something else to consider too. So to summarize, the tax advantage of the three advantages, if you believe federal income taxes will be higher in the future than they are today, hey, a non-taxable asset makes a lot of sense. And we know that cash value life insurance, compared to all the other non-taxable vehicles, does not include the income restrictions or potential sort of backdoor taxation that you're going to see with all the other products in this particular tax category. So that's the tax advantages of IUL. Now let's talk about the advantage of not having to make up for market losses, and that delves into the index portion of an IUL. Now, we're really comparing IUL to some sort of market-based product right now. Most people, or a lot of people, have money in mutual funds or variable annuities or portfolios within their 401ks that are subject to all the market ups and downs. We've certainly seen that in recent weeks here. But an important question to ask is, what does it take to make up losses in the market? We know it's going to be going up and down, but what if you didn't have to make up for these losses? I mean, do they really have a big effect on your portfolio? Well, here's a few examples that really help this make sense for everybody. In this scenario, we've got a client with $100,000, and what if this is in the market and every other year they either gained or lost 10%, right? So year one, you gain 10%, year two, you lose 10%, you gain it, you lose it, and that goes on for 10 years. I bet if you ask just a random person on the street, if with an even number of 10% losses and gains at the end of 10 years, they'd say, I would break even. I'd be back where I started, right? Well, that's wrong, because if you lose 10%, you're going to have to make more than 10% just to get back to where you were previously. And so you can see on this chart here, if you continue down that path, this person would actually have a loss of $5,000 at the end of 10 years, even though if he averaged their gains and losses 10% and 10%, you'd think it would be a wash, but that's not actually how all this works. Now, how it does work, if you have an index product, and this could be an annuity too, they all work the same. What if, we had a cap on the index of 10%, but the market gained and lost alternately 10% every year? Well, we wouldn't have to make up those losses ever. We just stay where we're at and delay the gain by another year. At the end of that 10-year time period, now we have over $160,000 on our $100,000. Meanwhile, the other guy who had the money in the market is sitting at a $5,000 loss. So I would much rather have my money in some sort of an index product, because we don't have to make up for those losses. Here's another example, and this one, we took a look at the actual S&P 500 returns for a 10-year time period, 2000 through 2009. So we included a little bit of a dip there around 01, 02, and of course the recession in 08. And if you had the same 100,000 in the market, you'd end up with a negative 1% return for that time period. If you had the money in an index product and with just a 9% cap, you would have seen an average return of just over 4% for that time period. I think anybody would take the 4 over the negative 1 in that time period. Now, here's another example looking at a little bit different time period. In this case, we're going from 2004 to 2014. So we're missing that first little recession at the beginning of the 2000s, but we're still catching the big one in 08. And same sort of story here. If we don't have to make up for those losses, we end up ahead. I mean, in this scenario, we had time for that market to recover pretty well, but we were down so low to begin with, we had to dig ourselves out of that hole, whereas the person with the index product doesn't have to worry about that at all. They can just enjoy the escalator ride on up to the top. So not having to make up for market losses makes a big, big difference long term when we're looking at retirement income growth as well as distributions later. So now getting to the third big advantage of using an IUL, and that's the extremely low fees in this product compared to everything else out there. And a question you might want to ask or analyze next time you're looking at somebody's retirement plan. I mean, how much are they really paying for the returns that they're getting in the plan that they have? I don't know that many people really seriously look at the expenses within a 401k or an IRA or even a managed account. So here's some examples, some typical fees of what these people might be paying, and I pulled these out of a book, the No Compromise Retirement Plan by Martin Ruby, one of the absolute best books on the market on IUL. If you don't have that, you want to add it to your library out there. But in his book, he gives some examples of typical fees. Variable annuity, clients are going to be paying about 3% on that money. Managed accounts, a little bit less, 2.04. 401ks, we're looking at just over 1% per year. And index universal life, usually less than 1%. And we'll go into that in a little more detail in a little bit here. But if you're comparing fees in various products, I mean, you have to pay somebody for their services to manage the money for you. We expect that, but you don't want to pay any more than what you really have to. And I would take less than 1% over a 2 or 3% any day. I don't want to give up that much of my returns. So one thing that I did a few years ago here, I actually had an agent send me a 401k statement from a client that he was working with. And this dates back to 2017. But at that time, this person had $130,000 in their account, and they were contributing $6,000 a year into there. And we looked at the expenses in there and later compared it to an IUL. Well, once we looked at the admin charges and then the expense ratios on each sub-account, it turns out that this person was paying $1,700 in fees for that particular year, even though they were contributing $6,000. Now that seems like a lot of money, right? $1,700 out of the $6,000. So he really wasn't putting in a total of $6,000 to go to work for him. And we did a comparison and said, well, hey, what if we put in $6,000 a year into an IUL? This person was 44 at the time. And I ran an illustration so that it would show the actual expenses every single year. That's a supplemental report that you can run on many IULs out there if you don't mind the extra pages to what's already a 30-page illustration. But I looked at the expenses, and I just picked a few years out of there and ran the average expenses at different time periods, because these contracts are usually front-end loaded, and at different times you're going to have different charges within the life insurance. But I averaged the expenses in years 1, 10, and 20, and it came to $1,000 a year. Compare that to the $1,700 that the client was paying in their 401k. So they're saving a lot of money right there just by putting money into the IUL. Well, that's a fairly complicated way to compare expenses. You've got to look through the statement, then you've got to run an illustration and run some averages. There's probably an easier way to do this. And this is maybe a more direct way to compare expenses. So with brokerage accounts, clients are, if they are looking at the expenses, they're looking at the percentage fee. They might be able to find, this account, there's an asset management fee of 1 point something percent, and the other one is 1.5, and so they can figure that number. It's a little more difficult on a life insurance illustration because the numbers are not expressed that way. You'll see actual charges every single year, but not a percentage. So there is a way to come up with that comparison. And what we want to do we'll get there eventually, everybody. we want to look at the average charges in the contract over the client's life expectancy. That's probably a more fair way to look at it, because these contracts are going to be heavily front-loaded. But as we get near the end of the client's life, we know the cost of insurance is going to go up, but some of the other charges and fees will be much lower, and especially in relation to the total cash value, the percentage is going to be going down. I like to use age 90 as a client's life expectancy. It's a little bit higher, but we know people are generally living longer, and they do so over time, and it's a nice round number for these calculations. So what we're going to do is run an illustration, but we're going to have it show the internal rate of return on the cash value. And then we're going to look at what the internal rate of return is at age 90. Write that number down. Now, to figure out what your average charges are in the contract, we want to take the illustrated interest rate and subtract our internal rate of return on the cash surrender value at age 90. And that is going to give us the cost of the life insurance contract as a percentage of the cash values. And this is going to be the average over time. So your formula, it's really pretty simple. It's the rate minus the cash value, cash surrender value, internal rate of return, and that's our cost as a percentage. That's something we can use to directly compare to another alternative account. Well, that's a little bit complicated, but I actually did that and crunched the numbers with several of our top insurance companies here at Financial Brokerage. Ran the IULs on a male 40, the best rate class. We're still putting in $6,000 a year, and that's the equivalent of what this person could put into a Roth IRA every year. And he's going to contribute for 25 years until he's 65. And I ran these calculations, and you can see on the far right, that's what our average expenses are. Now, in on the slide from the book, it showed life insurance IUL expenses generally less than 1%, and all these are definitely less than 1%. In fact, 5 of the 6 are negative. So we've actually got negative average expenses on the IUL. You can't do any better than negative expenses on a contract. Now, this person was fairly young, and we assumed the very best rate class out there. If he was standard, maybe we wouldn't be in negative territory any longer, but we'd be barely into the positive territory. And I will tell you, these things don't look quite so good when we get people that are table rated. If they're table 4, it might be a wash one way or another. So as long as people are healthy, I'd say generally standard or better, this is going to look really good and be an advantage to the client, and especially if they're preferred plus. We're going to be in this negative territory for people in their 20s, 30s, and obviously even into their 40s. So that's it. That's the big 3 advantages of using an index universal life contract for retirement income purposes. We don't have to worry about paying taxes. We don't have to worry about making up for market losses. And we don't have to worry about high fees, because the fees compared to everything else out there are very, very low. So we're going to open it up for questions in just a second, but I'll put in a few promotional plugs here in the meantime. I do have some additional webinars on IUL scheduled for the coming weeks. Check your inboxes for the invitations, but the next one will be covering the sequence of returns. We're going to go into a little bit more detail on the whole no market losses category, but particularly the difference it makes when you're taking distributions in retirement, and when those down markets happen. Does it make a difference? And what if you had money in an IUL? And then a couple of weeks after that, we're going to delve into how you can design an IUL to position yourself as an advisor. A lot of people throw numbers out, and I think there's probably a better way to go about this by asking the right questions of your client and then properly designing their unique retirement plan. So check your inboxes for those upcoming webinars. And we'll go ahead and see what questions we have. And I want to thank everybody for joining us here today. If you need some specific illustrations put together, feel free to call us at 800-475-5555 or email. That's exactly what we're here for.